Okay, good morning, everyone, and welcome to this morning session of the Coffee Microcaps Morning Meeting. You're very welcome. For all our regular attendees, welcome back, and for any of our new attendees, you're very welcome. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who's joining us for the first time, please note we're just going to run through a couple of quick intro slides, and then we're going to get straight into it with our first presenter. I'd like to quickly thank RAS Research for sponsoring all our virtual events here, Coffee Microcaps. If you're looking for some independent research on some small and microcap companies, please do check out their website. They've had a plethora of notes up in the last couple of weeks with annual report updates and Appendix 4C updates that have been announced to the ASX. Quick compliance and disclaimer side, and welcome to anybody from ASIC who's joining us this morning. For anybody who is joining us for the first time this morning, the companies we tend to have on here are capped under 300 million, our definition of a microcap here, Coffee Microcaps, generally in revenue, cash flow, break even, or indeed already profitable, like our two companies presenting this morning. We generally don't have companies from the resources and biotech sectors, so what we kind of define as industrial microcaps. Structured this morning's webinar. We're going to have two ASX companies presenting, now four. Each company get 30 minutes. We'll do a 20-minute preso and a 10 minutes of Q&A. If you do have any questions for the audience, please type them in the Q&A box rather than the chat function. Just makes it easier to moderate the questions to our presenters. And please note the webinar is being recorded and it'll be posted on the Coffee Microcaps YouTube channel next Monday. Follow us pretty much on all the socials. Twitter is probably our main one. YouTube, as I said, for the recording of this webinar, and indeed all our other webinars. And we've probably got well over 200 on there now at this stage. And we do a newsletter on Substack. Our first presenter, who we're going to get to in just a moment, is Sam Budiselik from Cash Converters. Delighted to have Sam back with us. Sam presented at our conference live event in Sydney and Melbourne back in March. And also joined us in Sydney back in March was Brendan Malone from RAIZ Invest. Should be no stranger to our regular viewers on here. But that's enough from me. I'm going to stop sharing my screen and hand you straight over to Sam. Sam, if you want to share your screen, I'll let you know as soon as I see the cover slide of your presentation.
Yeah, I'll do that now, Mark. I should be sharing. Can you see?
You're coming through just, yes.
Can you see that presentation, Mark?
Not as yet.
Yeah, I'll just...
Let me just see here.
There you go again.
Yeah, it's coming through now, Sam.
Yeah. Great.
There we go. I can see that's perfect. You can take it away.
Right. Thank you, Mark. Yeah, look, as you were saying, Mark, since we last caught up, a fair bit's changed for Cash Converters. We've had a couple of significant acquisitions and further developments, just reviewing our business segments, and I'm delighted to be here. Thank you for having us to talk about that. I did think I'd just start with a bit of a refresher on Cash Converters. It's obviously a business that has been around for nearly 40-year anniversary this year, so for a long time. But over that time, it's really changed a lot. I think the best way to think about Cashies in the modern day is that we do still operate that store retail buy-sell network that we have been known for over time. But what's really developed over recent years is the personal finance business, the service of our customers requiring small loan amounts. And the two businesses operate in tandem, very well. We'll talk about that. And over time, we've invested in our technology heavily. So whilst we're known for that bricks and mortar retail network, we have a very sophisticated online business servicing retail customers and our finance customers as well. We did grow originally through a franchise model, starting out of WA, expanding nationally, moving internationally. But our core markets we focus on are really Australia, New Zealand, and the UK. And we'll talk about that in a bit. I did want to show a video of a store, which I'll play now, just to give the viewers a feel for the changing feel and look of the stores. Hopefully you can see that video, Mark. Hopefully that played okay, Mark. So whilst the stores are still in place, the inventory mix has really changed to a higher end mix of inventory. The circular economy element of our business is still very key to our business model, buying and selling and repurposing goods. But in the overall scheme of things, when you line that up against the personal finance business, that store segment contributes about 1/3 of the company's earnings and 2/3 coming from the personal finance business. So, you can really see the need in the community for the personal finance service that we offer. It's really appealing to about 3 million Australians who, for whatever reason, struggle to access credit and regulated credit in Australia. And we'll talk about how we do that. But the Cash Converters brand is highly trusted, unaided awareness of sort of 90% when market surveys are run, very well known and regarded, particularly in our customer segment. And as the market's changing, we're reaching a wider customer audience, which is exciting. Just briefly, in terms of our business model, we operate a very large business. We deal with a lot of customers through various touch points, but we process, around 600,000 retail buy-sell transactions through our stores a year. So someone coming in, selling an item, someone coming in and looking for something, generally more value-conscious consumers. But as I say, that inventory profile is changing. We're reaching a more middle market than we have done in the past. We receive circa 780,000 applications for small loans a year, and we're operating online where that's a high volume, a lower approval rate environment, and we're sourcing personal loan applications through our store network. And the stores are important with the personal finance business because it's a much stickier and more direct relationship with the customer than an online applicant. But both channels are important, and I think it just shows that need for cash in society. There's definitely a growing pressure on customers with cost of living. I think the advent of buy now, pay later a few years in has people concerned that they're losing control of managing their expenses and their credit. And, they're coming back to Cash Converters and other regulated non-bank lenders such as ours to deal, which is great. With nearly 100,000 active personal loan customers in our loan book, it's a big business with a lot of transactional data flowing through. As I mentioned, we do operate what we call corporate stores, company-owned stores. And I think the best way to think of that is really the franchise network model that was originally the preferred model for growing the network. Over time, we've been buying those franchise stores back, and we'll talk about why that's a good idea. But, of the 150 stores in Australia, we now own about half of the network, 75 of those stores, and 75 remain franchised. We operate online and globally, and we'll talk about that in a minute. I think really central to our business model now is technology, and it's front-facing, customer-facing apps and mobile websites and customer self-service capability, where our customers can log on online and check loan balances and make loan repayments and download loan statements like you would with a bank. And also all of our retail is offered through what we call our web shop, our retail site. And, whilst it's displayed in store, it can be dispatched, nationally. And we do often sort of partner into the leading online commerce sites who are looking for eyeballs and inventory and listings. Our store offers the opportunity for someone to go in if they're local and view the item. But all of the inventory that we sell is backed by warranty, returns policies, and has the backing of a trusted brand behind it, where I think people feel comfortable buying from us. So if they have an issue, they'll be well serviced. Predominantly, though, the technology that we deploy is really around our credit models, because our borrowing customers don't have a lot of mainstream data available. So we really don't rely so much on a credit file like a bank would. We load the bank statement information for a customer and other data points, and build our own credit profile of that customer and our own risk score to determine, really we're trying to predict the propensity to repay when we're giving someone a loan off fairly limited data. So we build our own credit over time, and that's really important. And, the product offerings we've got in that personal finance business, small, medium loans, it's that sort of loan size showing on screen. And the retail buy sell, as mentioned. And we do have a small income line for franchise fees, and I'll just talk about that on the next slide. So the business model shown here really is depicting a global model, but as mentioned at the start, we're very focused on Australia, New Zealand, and the UK. The orange bubbles there show the corporate operated and owned stores in those markets that we own and run. And the other stores in those markets in the grey bubbles are franchised. And that provides optionality for the company going forward to continue buying those stores back and folding them into our network. And it's a low risk way for us to continue to grow our earnings. It allows us to, in some instances, fund existing franchisees to then continue expanding and growing, the good operators. We won't introduce new franchisees into our model per se, because our strategy is really to take control of the networks in those key markets and continue to own those stores. The rest of the world, we run a license, master franchise or license operation, and our partners there really use our brand and our IP, but they operate that business as a standalone entity in those markets. It gives us good brand recognition globally and exposure more than anything in those other markets. In terms of our financials, the company market cap is around 138 million at 30 June. We did put out an unaudited Q4 update, calling out full year revenue at 382 million. That's up about 26% on the prior year. Our gross loan book is trending up to 300 million there. We've got a strong balance sheet with 50 odd mil of cash on the balance sheet, and generating really reasonable EBITDA and net profit. We've been paying a 2 cent per annum dividend for the last 3 years, which is a yield of around 10%. It comes fully franked. So, we really try and balance the business, investing for growth and making that return to shareholders. Like I said, with our technology, it's such a core part of this business now, and it's not to be underestimated how important it is and how hard it is to replicate what we've built. It's a real barrier to entry to this market. You need a lot of relevant data about this customer segment to train your credit models and to make the right lending decision, and also to meet your compliance obligations and really build a complete picture of that borrower at that point of application. And with a lot of volume, it enables us to do that. And then we've plugged the business into the, open banking and new payments platforms. It just essentially means that, we can shift cash instantly into bank accounts for customers and take payments. We use technology to authenticate products, like handbags, for example, where we can provide an authenticity statement. It's really enabled us to open new markets and engage in different product lines that are, you can imagine, quite hard to value and assess at times. So the business has really pivoted into a big tech house wrapped around an old business model, really. The look and feel of retail, you sort of see in that store video. The newer concept stores in Paran and South Melbourne and soon to be Bondi, smaller footprint, higher value inventory. A really different sort of mix and feel of handbags, collectible sneakers, trainers, high-end watches, jewelry, and electronics. And it's attracting a new market, and it's a lot more, I think, acceptable nowadays to embrace the circular economy, particularly in a younger cohort of consumers who are more concerned about the environment and reuse. And this is less stigma attached, I think, to purchasing pre-owned, which is terrific, and we're right at the centre of that. In terms of the finance business, like I say, that's the bigger engine for our business, and something that's really grown strongly as the banks have moved out of, the risk-off sort of environment for the banks where they'll only deal with prime borrowers.
Sam, are you back with us?
Apologies, Mark. Am I with you?
You're back with us now. Yes, I'm not sure what
Sorry, I
happened.
don't know what happened there. We were jokingly talking about tech CEOs with Zoom, but sorry about that. Apologies. I'll try and pick up where I left.
Yeah. Or I was going to say, do you want to jump straight into questions, or is there a few more slides you want to hit before we
Yeah,
jump?
I'll do a quick wrap up, Mark, if that's all right, and then I'll just jump into questions.
Okay.
Apologies.
No worries.
I'll just jump. If you
Yeah,
can see,
it's coming. Yeah, it's coming through now. Yeah, you're on. Yeah, you're on the slide that you left off on, Sam.
great. Apologies, everyone. Yeah, look, I'll just finish off briefly by saying where the banks are looking at the prime finance market, that's a credit score of sort of 800-900. Our customer scores are sub 500, so we're really dealing with borrowers who have irregular income or have had an issue with credit in the past, and that's really our specialty, risk assessing these customers and serving that part of the market. And it's a big and growing market, as you'd anticipate, with the cost of living pressures on customers at the moment. We're just seeing more and more applications coming to the business, so it's demand growing, and we've only got a very small slice of that market at the moment. Just briefly, the highlights, Mark, I touched on good revenue growth, strong loan book growth. I think the key with the loan book is too the diversification of the loan book. We were known for small loans. We've really moved away from that part of the market as we've started offering new product releases and opening to a wider range of customers, and also offering our good repeat customers lower cost loan options over time. And innovating and further driving the business in that direction is what we're all about. And then to close, our strategy really simply is to continue buying back those franchise stores where the owner wants an exit or we see some strategic value, and expanding our network by doing that, and innovating and offering new loan products and growing the current loan books as sectors of the credit economy become regulated that weren't prior, like buy now, pay later. There's a lot of focus on potential consumer harm in that market, which is a good thing, I think, for consumers. And strong balance sheet and continuing dividend payments is really our core focus. My apologies for dropping out, Mark, but I'll leave it there. I'm happy to take any questions.
Okay, perfect. Yeah, we've had a few come through already, Sam. So the first one is, and I think you probably would have touched on it in the prezzo when before we lost you there for a minute or two. The vehicle loan book, you've taken the decision to exit that particular offering. And the first question, we've got two questions around. The first one is, as that book is kind of generally wound down and matures and it kind of rolls off. Is that going to be replaced by growth in other books, or is that capital going to be redeployed into something else? Maybe just give us a kind of where to from here as the vehicle loan book unwinds.
Yeah, great question. I think as the third biggest provider of vehicle finance in our part of the market, we just took a view that we were subscale, and the amount of our cash equity, our cash in that book was high. It was about half of the loan book. And the return on that capital was substandard in terms of where we could redeploy that capital to generate a better return. So we went through a sale process. We decided we've got confidence in our provisions. We will run that book down. 50% of that book will come in over the first year, and maybe 90% of that cash over 3 years. And we'll take that cash over time, continue growing our core loan books, and use that cash to acquire our stores back. And both of those avenues generate a superior return on that capital than leaving that in that loan book.
Okay, I think you touched on the second question as well. There was a question on, profitability margins as you kind of exit the loan book. Is it kind of going to be recycled into higher margin, higher profitability products? Well, it sounds like it is.
Yeah, correct. Yeah, I think that vehicle market, it's a tough market to play in. The value of that security at times is questionable. They're older cars. You're out repossessing a car from someone who's not paying. It's not a great consumer experience. So redeploying that capital into our core Cash Converters branded business is where we're really focused now. That's what we do well. So that's what we'll continue doing.
And then a question on the buying back of the franchise stores, which is kind of continues in the background all the time. A question on, when you take it back, how does the profitability improve? Have you got like an example you can refer to? And when you take one back, do you find more loans get written through that particular franchise, or is it, better inventory stock turns controls, is it that side that lends itself to the improved profitability?
Yeah, I think our franchise network, first of all, it's a strong, profitable network. The businesses are profitable and the owners have been in the network for a long time. So the exits are generally people looking to retire and, later in life, they're looking for an exit. The way we look at these businesses is that we've got complete visibility of top line revenue sitting on our point of sale platform and our lending platform. But their cost bases will adjust for corporate ownership. So, we'll dial the cost base up in summary, just put a bit more resource into that store generally. And then we'll look at that earnings profile as a result of that and apply a multiple 3.5 to 4.5, something like that generally, depending on the nature of the network. Bringing them in, so the value accretive, but they do enable us to then accelerate our product development release. I think the business as a franchise model, as a starting point, will likely continue to morph to a corporate model over time as we essentially defranchise and drive the financial service business into the new market that it's sitting in now.
Okay. And then, as I kind of said at both our presentations in Melbourne and Sydney at the live events, regulation never too far away from this business. A question around, they're saying, they understand the rules and regulations around SACC, so your small loans, but maybe touch on, rates and repayment regulations around the MACCs and the larger size loans that you're starting to move into, while it's not I guess a large part of the book right now. It's kind of where the book is trending. So just maybe, is there a difference in the regulations once you kind of go over, and is it more favorable or kind of less favorable versus the small ones?
Yeah, look, firstly, we are regulated. That's not always known. I think that's a real advantage. We don't have to go through the possible pain that the buy now, pay later sector, likely will be heading into. We're very well regulated. There's good credit policy around this space of the market. With the medium amount loan, you can never say never. So we've innovated another loan product, that line of credit, and we'll continue doing so to diversify our overall loan book. But I think the core premise of our customers need cash. They need support to buy a washing machine, repair a car, meet life's unexpected expenses. And we do it in a highly regulated way, sitting under ASIC and AUSTRAC. And, I think I'd imagine there'd be tweaks to regulation over time ongoing, as you'd anticipate, which is a good thing. and we're all for that, and we've got a front seat with Treasury and ASIC on that in that respect. But I think the Mac product itself, because the headline costs that people get concerned about are lower in the Mac and then lower again in the lock. We've moved the business into that space that I think now advocates and regulators are comfortable with.
Okay. And then just one from me quickly. I know, the UK business is a considerable part of, cash converters overall business. And as you said, a focus area. New change in government there. And I see, Rachel Reeves, the new chancellor, she's, been kind of outlining what she wants to get done. Is there any noises coming out from the new government, promises that might turn into policy, but changes that you're kind of expecting there on the positive or the negative that, shareholders should be watchful of, or you're watching out for as she kind of heads into her kind of first budget and kind of first term in office?
Yeah, I think it's a great question. The UK, we don't offer an unsecured loan product in the UK. It's only pawnbroking, and that's the market in generally due to some historical regulatory changes. There's a big need for cash in the UK too, as you could imagine, and there's in general a walk back of some pretty punitive credit changes that happened over time. So if anything, a new government, it brings an opportunity for them to review supporting this part of the economy. The biggest listed pawnbroker in the UK has a book of around £100 million. We're at sort of £5 or £6 million. So, it's a big growing pawn market, and it's a well-regulated product. So I think opportunity in the UK to continue growing that pawn book is huge, and something we'll stay focused on. But in general, I mean, New Zealand and the UK have taken, a really, really restrictive credit policy to subprime support and near prime support, and they're having to walk it back because the need is there, the need is growing, and that unintended consequence of making it harder for people to get regulated credit means they go into unregulated markets. And I think politically people are realising that's not a good outcome. Have a bigger regulated provider of credit in this space is a better outcome. And, we sit front and centre of that in UK and Oz, so it's a good opportunity for us, I think.
Okay. Sam, we're bang on time there. So thank you very much for joining us. And
Thanks, Mark.
I know you're joining us from Melbourne because you were down at Techno. So safe travels back to WA, and we'll hopefully catch up with you sometime in the back end of 24 here.
Look forward to it. Thank you for having me, Mark. Good to see you.
No worries. And now we're going to jump straight over. We're going to go from Melbourne up to Sydney here, and we've got Brendan Malone from RAIZ. Brendan, I can see the cover slide of your deck now. You can take it away, mate.
Perfect. Thank you, Mark. And thanks, Sam, for that presentation, and all the viewers that have dialed in for this webinar today. What I will do is start with a quick intro to RAIZ for any viewers that haven't heard of us before or know what we're all about or what is our why. And then I'll have a run through our 4C numbers and quarterly commentary that were released last Friday, the 26th of July. So I'm rather very excited about these quarterly results and the direction that the business is heading. Over the last 12 months, we're focused on two key goals, and that was transitioning the company to be operating cash flow positive, but also to divest our businesses up in Southeast Asia. And we've managed to achieve those. Maybe not to the timeline and the expectations that we would all like, but we've done it in a managed way, and the business is moving forward. And I'm very proud of the team that have focused on both those goals, but also the continued growth that we've seen in the Australian business over the last 12 months. Customer numbers were up a modest 3.7% quarter on quarter, and FUM was up 23.4% over the year. I think that's a great effort in this environment. The team have done very well to maintain our customers, retain our customers, and also, as we'll see as we go through, sort of drive and improve the revenue, the relationships to increase the share of wallet that we have with our customers. So jumping straight into it, RAIZ. What is RAIZ? What are we about? We started RAIZ just over 8 years ago in February 2016 with two core principles. Small amounts add up over time. And we fast fast found out that customers need a different way to save, and asking them to change their behaviour is very difficult. So we needed to find an automated way using technology to create this saving and investing opportunity for many Australians. So our vision is empowering all Australians with hands-on experience to break down the barriers to savings and investing. And whilst the app's both on Google and the Apple Store, you can download it, there is also a web app version of it. But what it does is it breaks down the barriers to allow customers to start investing for as little as $5. That's $5 into a diversified of over 9 portfolios. And you can see on the slide the different 9 portfolios we have, but it gives that diversification and customers the education and the understanding of what is this capital markets business that they've spoken about. We at RAIZ are tired of hearing, oh, investing or savings not for me. It is. We break down the barriers for everybody. There's a few other product suites that we'll talk about going through the slides, but what we do is we provide that hands-on experience in the palm of the hand, financial literacy, financial inclusion, financial education for everybody. And as I mentioned, we started over 8 years ago, and as at the 25th of July, which was last Thursday, we had over 1.41 billion in funds under management and over 308,000 active customers. And if we just pause for a sec, 1.41 billion. Core principle was small amounts add up over time, and that's what we've managed to achieve with the Australian customer base. With this slide and over 308,000 monthly active customers, I just thought I'd give a visual representation of how our customers are and where they are in their life cycle, because we want to create and maintain engagement with customers as they travel through their financial or their wealth journey. And how do we do that? It's by the product offering that we have, delivering great customer service and making it easy. Earlier this year, we released a couple of stats just to bring it all into perspective, that we've facilitated over $440 million of savings and investing for Gen X and the millennials in the calendar year to 2023. That's $441 million that they haven't saved before or had the opportunity to save before. Over the 8 years, it's been to the tune of over $2.4 billion. And in that period, we've reinvested dividends to the total of $130 million. So that's dividends and distributions that a lot of these customers have had access to for the very first time. And in this cost of living pressures that we have out there, we know that every little bit counts, no matter how small it is. So our strategy and direction includes building the pipeline from RAIZ kids and attracting them early, and then maintaining them and having a relationship as they go through their life cycle. And we do that through market-leading products, which is first-time users. We started this business for first-time users, but as the business has grown and the customers have grown with us, we increase and we broaden the product range, appealing to both wealth accumulators and people that want to continue. And we'll get into the products and the offerings that we have and the portfolios that we now provide to our customers, and the innovation over the time period shows that we are working with our customers, listening to our customers to increase the lifetime value of brand and loyalty and trust over this period. So we make it very easy to save and invest. 6 ways to get your money into your account or deposits in is automated recurring deposits. We have a lump sum functionality, roundups, RAIZ, Acorns when we first launched, and today RAIZ, we really pioneered the roundup concepts in Australia. And what that means is you link your debit card or your credit card. We see your transactional data coming through. You might buy a coffee for $4.50. We round that to $5 and we invest that 50 cents for you. So that's quite popular. And a great way for people to understand small amounts over time do add up. We have a RAIZ Rewards capability, which is the cashback program to allow all Australians to save money on their daily purchases. And in this environment in particular, that's a very, very important engagement exercise. We have a referral program where you can introduce a friend and get a fee, just to help out a bit where we can. And then, as I said, we've invested over $130 million of dividends over the 8 years, or distributions, and that again assists with the compounding growth of your portfolio or savings over time. So making it easy to save and invest. Here's the 6 ways to save, and where do we invest them? There are 9 ways to invest. Portfolios number 1 to 5 is what we launched with 5 different portfolios made up of 7 ETFs, all quoted on the ASX. They haven't changed over time. They're doing quite well on a performance stat. And as we get into the quarterly numbers, I'll provide some performance details of those portfolios. When we first launched, our customer base said, well, we like to think about socially responsibly themed portfolios. So we created the Emerald portfolio, and it fast became our second biggest portfolio by customer numbers and dollar value. And then a few years later, the crypto hype of Bitcoin, and our customers were saying, well, what about this crypto thing? How do we work with this? So we created the Sapphire portfolio with guardrails of up to 5% of your portfolio to have Bitcoin in it. So it provides an understanding, an easy way to have experience the crypto or Bitcoin with guardrails on, which has been quite successful, and it's a very popular portfolio now. A few years ago, we did our first acquisition of a business called Superestate, which was Australia's only residential property fund within superannuation. That came together about 3 years ago, and that portfolio is now both in the super and retail, and we have a residential property fund that we run and manage, and I'm proud to announce that on Monday the 29th, we settled our 12th residential property down in Melbourne. And then over the last 12 months, I said that we've taken the business, turned the cash flow of the business around and divested from Australia. But it's important to remember that we also innovated for our Australian customers. And on the 1st of August in 2023, we released this Plus portfolio. Now, what that does is allow customers to create and weight their own portfolio. So it's giving them a hands-on experience on, say, the top 99 ASX listed stocks, 49 ETFs. You can have an allocation of up to 5% of Bitcoin or up to an allocation of 30% of the Australian Residential Property Fund in there. Last week, on Thursday, Friday last week, we released that functionality in our superannuation product so that our super customers can do that. And that was a massive demand from our customers so they could build their own portfolios. Here's a screen that just shows, and I think the important part about here is putting all the product offerings that we have on one slide shows that these product offerings work together, from a RAIZ Kids account on the right, getting into a RAIZ Invest account, working through your Plus. As the individual experience and financial education happens with the customer, we're on that journey with them. And we've got a RAIZ Invest super product that has about $288 million of FUM in there. So superannuation guarantee, voluntary contributions can all come in, and we're with those customers on that journey. And we're working with the trustee now on a retirement incomes portfolio so that after the accumulation phase, we can move out that product into a pension phase, and that again will increase the lifetime value of the customers. And then the overarching product that does help across the engagement and retention is our RAIZ Rewards program, where we have about 1,300 RAIZ Rewards or merchants on the program, where if you buy through them, you'll get cash back into your RAIZ account. So it's pretty strong engagement there. I think the overarching key ingredient across this is that we've developed our products from listening to our customer feedback. We have a great customer loyalty. We have great customers that provide their feedback from the littlest color changes to the actual product offerings, and we've got a track record of listening to them. Now, jumping into the Q4 results that were the 4C and business commentary that was released on the 26th of July last Friday. I'll run through these because they have been issued out. In the interest of time, I'd like to get to questions. But at a high level, the Australian operations have done very well, with revenue growth of 28.1% year on year to 5.5 million for the quarter. There's been a steady growth. I would have liked growth to be a lot bigger over the 12 months, but a steady growth of active customers. But I think, as I've mentioned, the key retention exercise, the challenges we've faced throughout the year has been a testament to the support team working with our customers. There's been a massive engagement and this cross-sell and cross-promotion of our different products, which has assisted with the continued positive trend in the Australian annualised ARPU over the period up to $72.10. As I mentioned, the portfolios have done very well themselves, and Super Ratings announced that our moderately aggressive super portfolio was number 2 over the last 12 months in the Balanced Super Fund. We're also highly rated in the Growth Fund, and also our Emerald portfolio on our social responsible themed portfolio is again achieved a top rating through Super Ratings. Another milestone over the period was 4 consecutive quarters of positive operating cash flow. The cash balance in the Australian business has increased, and we're sitting on just over $9.7 million of cash as at 30 June. Also, we've got our full year results coming out, so there'll be a lot more information coming out over the next couple of weeks. But as I said, we've had positive momentum in the underlying businesses and all our underlying metrics. And the number of 306 that we see on the slide there was 30 June, 306,000 active. We're now at the 25th, or last Thursday, 25th of July, we're at 308. So we've implemented some changes over the last sort of month and a half, 2 months, and those are starting. We've started the new FY25 year with great momentum. The momentum coming from last year shows that we have increased our average account balances from the 3,800 there on the right to over 4,500, but also to the cross-selling and the promotion of our RAIZ Plus products, our RAIZ Super products, and our RAIZ Kids products have all had some strong growth over the period. Putting our customers first and at the heart of our innovation, it has been key, as I said, and we've continued to innovate since we've started through 2016 through to 2024. And even last week, when we increased our portfolio offerings, our investment offerings in our Plus portfolio, we have a voting page on our website that members or customers can say what they would like to see in their portfolios. And on one of the social media channels, I noted that we put in 7 of the investments that the customers were asking for out of the 10 that we increased in our ETF offering. So strong engagement from our customers as we continue to listen to them and innovate the products for them. Some of the highlights that we've had, very excited in the last quarter in particular that automatic rewards are now live. So when I mentioned that there's 1,300 merchants in our system, you would have to either click on through or have a card linked offer. Now, because we have your transactional data for roundups, we can instantly reward customers for the loyalty that they're having with merchants. During the period, we went live with 15 merchants in the last quarter, and there was 4,700 eligible rewards tracked in the first 25 days. Now, that's what's great from a customer experience is that it's a bit of a surprise and delight. You might have shopped at Flight Centre. We see that transaction and you're getting a reward. You would never have received a reward prior, but Flight Centre are happy to work with us and pay a loyalty reward into your account. And as a customer, you would say Flight Centre has invested in you. And as I've already mentioned, the innovation continued in the quarter with the Plus portfolios into the Super offerings, which was highly requested from our Super members. And we increased our retail Plus portfolios to now offer 150 investments. What is key on our whole business is our customer numbers, and I'm very pleased with the customer loyalties that we have. They are key, and we've done well to retain, but also moderately grow those customers over the period. So a lot of the questions we do get is, okay, well, how do we do that? Now, there's 2 key exercises. One of them is going to be to bring in new customers, but the other one is also to re-engage and retain the customers that we have. And over the last sort of month and a half, as I alluded to, we've done some great work through the AI capabilities, our digital marketing focus, and executing on what we said at our AGM last year, that we had a strategy, the strategy's right, and now we've done a lot of the back-end work to make that happen. And I think the momentum that we've seen of over 1,500 customers to the 25th of July, increase in active customers has proven that we're doing the right things and we're growing. There's also too, we've spent a lot of time over the last couple of months working on strategic partnerships. We've mentioned a few there. We have a strong partnership with one of our shareholders, Channel 7, with the AFL and AFLW and Abby Holmes and the Morning Show. That will continue in the second half of this calendar year or the first half of FY25. And as the 4C alludes to, we have put a lot of our spend or our contra spend at the back half of the AFL season, where there'll be a lot more eyeballs actually on the TV as the competition comes to the pointy end. There's various other partnerships listed there, which I'm quite excited to get rolling in the next couple of weeks to continue to grow. And the overarching or the underlying opportunity in the marketing strategy too is to look for more strategic opportunities, whether we can grow our customer base through acquisitions or more meaningful partnerships. The overarching impact of RAIZ over the years and our data shows that we have provided financial education and opened up a lot of markets, a lot of opportunities for our customers. So it's key that education and financial literacy, by educating customers young, they will stay with us and they work with us because we break down the financial jargon into bite-sized pieces of information that they can understand. We pulled a stat the other day that we send out a weekly newsletter on a Tuesday that gives a bit of a market update in small bite-sized informations and some financial definitions and some articles. and it's going out to customers with over a 40% open rate every Tuesday morning. Yeah, the customer support team and it's great to see that customers are closing their account they've reached their savings goal or they need some money, but they say, look, I need to withdraw my money, but can I still receive the financial education on a weekly basis? And it's now starting to ingrain. We've seen a 53% increase in deposits on 12 months last year to 12 months this year, because customers are understanding the importance of saving and how that they can use the technology to automate those savings and not necessarily change their lifestyle. So to wrap it up, a few of the key highlights. I won't run through the 6 points that we have there. I think it's key over the next period is that we continue to focus on our cross promotion as well as the customer acquisition. We have a great pipeline of new active customers through our RAIZ Kids accounts, and we go right through the life cycle and the financial journey through to our super products. The exceptional customer support that we provide continues with the retention and also the cross promotion of our other products, with over a 98% satisfaction score from our customers on our surveys. Innovation is key. Customer retention is key. Our technology, we do spend and reinvest on our technology to make sure it is best in class, and that includes the user experience, but also the back end on security. Looking forward, we are tracking on path to positive EBITDA, and I'm pretty excited for the next couple of weeks to get these results out. In the interest of time, there's the last slide on the market information. I'm very pleased with the supportive shareholders we have at the top holdings. They've been stable over the last 12 months and continue to support. And also just quickly there, in our 4C announcement last week, we announced that we're on Investor Hub now, which will give everybody the opportunity to ask any questions. So if you haven't seen that, I ask that you look at that and the login details that are on the 4C. Mark, on that, I'll hand it back over to you.
Thanks, Brendan. Yeah, we've had questions coming in thick and fast there. So let me just grab the first one here. Now that the Indonesian, Malaysian businesses are, pretty much wrapped up at this point, there's a few legal processes, I know, to just completely exit those businesses. But a question on then, if we're looking at the Australian business, what's the operational leverage you'd expect to see, or shareholders, if you go from 1.4 billion in FUM to 1.5 billion, that every extra 100 million that kind of comes onto the platform, whether that's roundups, people doing the monthly, weekly investments, market movements, what does the operational leverage start to look like now?
I think it's important, Mark, I'll just touch on the fee structure for any viewers that don't know. If you open up a RAIZ account and you get your account to an active account balance of $5 or more, we charge it's a subscription or a maintenance fee of $4.50 per month if you're in the first 5. It goes up to $5.50 a month if you're in the other portfolios or the plus portfolios. Once that your account balance gets above 20,000, we move to a 27.5 basis points per annum paid monthly. So it's not so much about the FUM that comes in, it's more the active customer numbers. So by putting on the active customer numbers, and even you could look at it by saying, well, what's the annualized revenue per user? New customers times that's what it's going to do and drop through. Whilst I expect the revenues to increase positively over the next 12 months, we do reinvest in the business. It has to be, we've got to continue innovating, we've got to keep our customer experience and our engagement there, but it is quite, we're at an operational cash flow level now, so things do drop through.
Okay. And then another question, and I don't know if it's going to be in the wider deck, a split between, growth in FUM from assets coming onto the platform versus, just to move up in the market. We've kind of been hitting record highs on and off over the last couple of months. Have you got that disaggregated data at this stage?
Not at this stage. We can put that in and look to put that in the full year results in a couple of weeks. We are seeing some continued great record inflows. And the 6 months to date to June, we've seen customers depositing, has seen an increase of 19% over the last 6 months on average of what people are depositing. And I think that comes back down to the education that's saying we have continued inflows because people are using the automated features, whether it's daily, weekly or monthly, and continue that savings process.
Okay, and then a question on the 4C. Revenue was 5.5 million, but the cash receipts was higher at 6.2. So obviously there's some kind of, small timing difference. Was it something carried over from Q3? Maybe just touch on, I guess, why they don't line up that closely, if you
Yeah,
can.
that is a very good question. And the Appendix 4C at point number 1.1 is receipt from customers, and that's inclusive of GST. And that's at a group level, the receipts coming in. So if you take the 5.5 million Australian revenue, GST is 10% of that, and then there was about 200K of Malaysian revenue.
Okay, perfect.
So,
yeah, that explains that. And then just I don't know if you have this stat, this is maybe one from me, but as the kind of product base has expanded between, Super, RAIZ Kids, the traditional portfolios or the plus portfolios, have you seen a gradual increase of that cross-sell working? Is there a number somewhere that, people take 2.4 products on average, or 3.1 products? Like, is that cross sell trending? Because as we know in financial services, oh my God, we've seen so many banks trying to get into insurance companies trying to get into banking, and then they dissolve the whole thing, and then the new CEO 10 years later comes in and tries to do it again. For whatever reason, cross sell in financial services is a difficult nut to crack. It's not to say it can't be cracked, and there have been companies who have managed to do it. But are you seeing that trend as the business matures and the new product offerings come on, that your kind of existing cohort of customers who've been with you for a while and know how the whole RAIZ ecosystem works, that they are, flipping over their super, or, having RAIZ super on the side as well as the one that they've got from, their work, and they're getting the kids account set up? Maybe just touch on that cross sell.
Yeah, definitely. Look, there's a couple of points there, Mark, that you raised, and I think one of the initial cross sell or cross promotion products is going from one of those 1 to 6, the conservative up to the aggressive or the emerald at $4.50 a month. We want to move them as they get experience, and we can see the life cycle or the persona of the customer. They come in, they get used to it, they put $10 in, they withdraw $10. Yes, it works. They put in 100. Then a couple of weeks later, they automate everything. Then they get some experience, and then they move up to the plus model. So we're pushing them up the value curve there. So that's a key target and a key messaging that we want to put out there to our customers. The second one is that cross-promotional, is it RAIZ Invest, RAIZ Super, RAIZ Rewards, and even into our property fund, because we manage that. There's some management fees there that we collect. So it's putting the right product in front of the right customer at the right time. And that's what we've done. We've spent the last sort of 6 to 8 weeks on the AI capabilities in our system, because we have so much data. And that's the transactional data, the behavior data, the demographics of our customers, their banking data. We know what they're doing and where they're doing it. And we've rechanged our modeling system. So instead of sending a blanket 120,000 messages out, for example, we've got 10 different messages sending out to cohorts of 12,000 people. And the system now that we've implemented through AI is like, well, here's the A/B testing. How quickly can we change those messaging to get out? And that's what's really happened sort of late June, early July. And we can see that cross-sell and that re-engagement activity in the July momentum of our customer numbers has really worked.
Okay, perfect. And then there's a question here. I know you did touch on it in your presentation about the ratings that you've got from various industry ones. But question on how does the super performance and fees compare in the APRA yearly reviews? I don't know if you guys submit data to those APRA surveys, or if they pick you up in the APRA surveys.
We do, but that runs through our trustees. So they're working on those numbers now for 30 June. So our trustees EQT, and as they're the trustee of the super fund, with DDH Graham up in Brisbane, who's the administrators, and then we're the promoters. But the numbers that we mentioned that have been put out through super ratings are our superannuation portfolios. And at 12.1% for the moderately aggressive portfolio net of fees, it's pretty strong. And we put out a blog to our customers, because our customers do ask for it, what has been the annual return of our portfolio. So we'll get that out in the next couple of days.
Okay, perfect. And then maybe this is maybe one for the full year numbers, but you said tracking toward positive EBITDA for the last two 4Cs. Can you be any more specific on timing is the question.
Look, I would like to hold that for the full year results because as I said at the start, I'm quite excited about getting these results out because we wanted to split out the in more detail and be a lot more transparent on the Australian business versus the divestment of the Asian businesses. So we will see that coming out in the next few weeks, and I think that'll answer a lot of questions. But we will have a webinar for our full year results, so I welcome the question then as well.
Okay. And then just another question for me on the Seven West deal. I think, correct me if I'm wrong, but it was a kind of a 7 million marketing spend, which is quite a, it's a large chunk of change to spend on marketing. It's still got a bit to go, as you say. It's going to probably wrap up in the next 6 to 9 months. What are the plans then for marketing? Because once that kind of drops off, are you going to look to re-engage with Seven on the program again? Maybe not to the same amount, or are you going to focus on digital now for a while? What's going to kind of, because there's going to be a big drop off in marketing, and you don't want people to suddenly think RAIZ has kind of disappeared off the radar.
Absolutely. Good, great question. And it's a conversation that we're having not only at the management level, but also at the board level. Seven's been a great partner over the coming up to 3 years. And it was an $8 million contra and a $2 million cash for the 10 million equity placement just under 3 years ago. So the conversations will be there. What I'm very pleased with the strategy and the marketing strategy that we developed for the AGM or November last year, and now it's being executed, is that we've got the tools at our own disposal, and a lot of our customers, we're a leading example of a fintech company or financial services company acquiring customers online, and by having this AI language model capability that we're building in-house, is we can get to the right customer at the right time. So the Seven West does two things. It's out there, it's on TV, it's on the big screen. There's brand awareness, but also that brand re-engagement and customer acquisition. Now it's our job to follow up those leads. And if you look at our customer funnel at the moment, we've got about 1.5 million people, 1.5 million Australians have downloaded the app. About just over 700,000 have been KYC'd and had money with us at some stage, but we've got 308,000 active. So this whole change in marketing strategy and the re-engagement is to flip that around and get those inactive accounts back to active accounts. And that's a lot of those were earlier where the product was this big, now the product's this big, and we can service customers through the whole journey of their financial requirements.
And then one final question for me. I'm going to squeeze it in. I know we're just up on time. The automatic RAIZ rewards sounds like a great initiative both for customers, but also for you, because those rewards balances come into the account in the platform. In terms of expanding that, across the full 1,300 merchants that are on there, I mean, how feasible is that? I know you mentioned Flight Centre, and I'm sure it's easier to do with the bigger guys as opposed to maybe some of the smaller ones. But I mean, these 15, I'm guessing, are kind of some kind of initial pilot to get everything up and running and working and stuff. But how feasible is it to roll that out? Because to me that sounds like a very, very attractive thing, where if I don't have to click a link and it's automatically coming in from day-to-day spending, it should drive very decent inflows onto the platform.
Yeah, look, it's going to be a harder burn, and it's all about the merchant being able to track. How do they know that I'm not just saying here's a heap of transactions, pay us rewards? So it's getting the merchant comfortable. But with the 15 that we went live with in the pilot, it has improved, probably to sort of 80 to 90%. The loyalty from a customer point of view. So we'll get a few test cases drawn up, a few pages, and say, look, this is the loyalty that we're creating. You need to be part of it. And there'll be some goals to get some of the big enterprises organizations on there, the Woolworths, the Audis, the Coles, get them, because what we like is that surprise and delight from a user experience point of view, because whatever cashback they get comes into their account, and it might say like Flight Centre has invested in you. So that's a conversation started to your friend at the barbecue, someone else or family, to get more customers on it. And automatic rewards is very big in the UK and the US, but no one's doing it down here. So we're very excited about that opportunity moving forward.
Okay, perfect. Brendan, we've gone slightly over, and I don't want to take up any more of your time. So thank you very much for coming back and joining us. And yeah, the same as I said to Sam, hopefully we can get you back on here later in 2024.
Absolutely, Mark. Appreciate it. Thanks. And thanks for everyone for dialing in and listening. Any questions, please send them through.
Yeah, and just a reminder to everyone, we've got 4 more companies presenting tomorrow morning. We'll be back 9 to 11. We've got Pointera, Worker, Pure Profile, and Kinetico joining us tomorrow morning. So please dial in for that. You'll find all the Zoom logins on LinkedIn, Twitter, or if you're on our email database, you should have got an email at this point. And with that, we'll wrap up today's session and wish everybody a good rest of their Thursday. Thank you.